Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're getting on board a plane and we're going offshore for the first time ever. We're going global. We're going to have a look at those markets around the world where everything's exciting. And to talk to me about it is Nathan Bell from Peters MacGregor and Chad Slater from Morphic Asset Management. Start with you, Chad. Yep. Everything's great out there, but is it a case of the grass is greener over the fence? And are there things to look out for when we invest offshore?
Yeah, absolutely. I think when you go offshore, like investors, for us, the key thing they should think about is currency risk. So for example, if you buy a stock in Australia and it goes up 10%, that's what you're going to make at year end. If you buy a stock in the US and it goes up 10%, but the Aussie goes up 10%, you're going to end up with zero. So you really need to have a fairly firm view about why you're going offshore. Now, luckily enough, we have a fairly firm view. We think the Aussie's going down, so it's going to be a tailwind, but they really need to consider that.
But you can't do much about it. What do you do if it is going up and down?
I think that's one of the roles for fund managers. Obviously, I'm self-vested interest here, but is to help you make a decision about whether you want to have this risk in your portfolio or not. You can either hedge it out, but usually for a self-managed directed investor, it's difficult to hedge.
Part of the equation. Yep. Okay, Nathan, why wouldn't you invest offshore? I mean, Australia's been a huge underperformer, especially since the GFC. Even New Zealand has eclipsed us quite comfortably. But is that right? Is that the main reason we should go, or should we be careful of something?
No, I think there's a lot to be careful about. The US market now on many measures is the most expensive it's ever been. It might seem like it's a great time to go overseas because you're a bit frustrated maybe with your returns in Australia, but you've got to take all the same things that you look at your stocks in Australia with, so whether it's a great balance sheet, competitive advantages, whatever, you've got to take all those reasons to the US as well and everywhere else. And if you're outside the US, I think most people think about the US when they go overseas as actually really volatile stocks. I'm going to talk about one today. So you need to be aware that if you're in South American markets or India, the stocks can be very volatile, even if the intrinsic value of the companies hasn't actually changed.
Even if it looks outstanding. Okay, we're in unusual times, Chad. We've had incredible leadership and it changed some years ago. It's tech, it's FANG, it's all these acronyms. Is that set in stone now? Is that the way the world's heading, that leadership of those big tech companies? Can we rely on that for the next 5, 10 years, the next session?
I'd say probably not. You can't rely on it for the next 10 years. The main thing, just think of it this way. 10 years ago, the US top 10 looks nothing like it does today. So if they weren't there then, they're here now. Arguably in the future, there will be XYZ company you haven't heard of. They'll be in the thing. That, by the way, is interesting because if you look at the Australian top 10 compared to 10 years ago, not much changes. So that dynamic nature of the US market is really, really interesting. Can it stay that way? I don't know. It's on average, these things don't last.
Okay, so we're going to change again.
I think we will end up changing again.
Okay, Nathan, you made a terrific point before. When we think of overseas, we think, let's go to LA, let's go to New York, let's buy Apple, let's buy Facebook. And they have been leading the world. And it's an unusual time because these massive companies are still growing at enormous rates. Why is that? And what's going to change that?
Yeah, I think one of the things is these companies have just gone so global so fast. These advertising dollars, you don't have to be in the US to avail yourself of Facebook. You can be anywhere in the world, and I think just how fast that's spread, that's one component. And the other one is I just think how profitable these companies are, and the fact that a bunch of them don't even really need capital to increase their earnings. And I think that's very, very different from the old school businesses that were very staff heavy and actually required a lot of physical investment. I think it will change at some point. I just don't know whether it's going to take it to the next recession until we see the cycle play through some of those advertising earnings.
Well, we don't want another recession. We haven't had one for 27 years here. Okay, one of your favourite subjects. Value investors versus growth investors. The poor old value guys, they're scratching their head, what's going on? The growth guys are saying, come along for the ride. Is that going to change? Is value going to have a comeback, or is it all about growth?
I think it's definitely going to have a comeback. If you look at the graphs at the moment, the performance of growth stocks in the US compared to value stocks is now at a peak that we haven't seen since the internet bubble in 2000. So I definitely think value stocks are going to come back at some point, but I think you've got to be extra careful these days that you're not just buying complete garbage just because it looks cheap, because technology is changing businesses and industries across the world, and you don't want to end up buying a business that's actually got declining revenues and actually is just a value trap.
But that's a bit of magic, isn't it, in the sense of how you pick that, because you've got to look out into the future, and how do you avoid those value traps?
Yeah, well, for us, it's actually the same process for value and growth stocks. All we're trying to do is discount the future cash flows. So whether they're growing quickly or slowly, it doesn't matter for us. It's just about what's today's valuation, and are we paying or getting more for those cash flows than what the market's currently pricing them at, regardless of how quickly they're growing.
Okay, it's been a case of Jack and the Beanstalk. These growth stocks, they just keep growing and growing and growing from the little seed. Is that going to change? Is the value guys in the world going to be having a party at some stage, or are they just going to be depressed for the rest of their lives?
Well, as a value guy, it's been a depressing 10 years. So value's underperformed, as Nathan pointed out, for a decade now. What's interesting, and it was also touched on earlier, is platform companies. So traditionally, one of the reasons why great businesses didn't stay great is ultimately they got arbitraged away. But there's something about these tech stocks where a monopoly seems to be the best outcome, where one company dominates.
Yep.
So whilst I said earlier that leadership may change, the most dangerous sentence in finance is this time it's different. But
it is this time.
But maybe, I'm open to the idea, even as a value guy, that things might be a bit different in a tech-based global world. I don't know. A decade's a long time to keep underperforming. We've given back almost 20 years of value outperformance. So at some point, one must consider that maybe it is different.
Okay, with those...
Hold me to that one.
Okay, with those dangerous comments, where is the value in the world given the new environment that we just discussed? Yep. Where are some of those pockets? Get granular. Tell us some details.
Okay, one area I would say it's not is the US. US stocks are trading on high multiples, even allowing for their better growth prospects. So we'd nominate two areas, Japan and China. Japan, things have changed in Japan. It's trading on a lower PE than what it was 6 years ago. Companies return cash to shareholders. So all these things that you'd want to see out of a company, they're not being rewarded by the market. The market still thinks they're cyclical. So that's an area we see some great opportunity. And the other thing is in China, one of the interesting things about growth is when GDP is really good, generally equity returns are really bad. So what's actually happening is slowing GDP often relates to better equity returns. And we're finding some stocks in China, which have very good multiples for their growth still.
Okay, terrific. Nathan, in that new world environment, is there any value, or are we just kidding ourselves and we've just got to close our eyes and buy big, expensive stocks?
I am a value guy also, and I don't really like talking about banks from the Australian zone, so many already, but the European bank prices have come off around 25 or 30% in the last 6 months, and I think this is largely due to people's frustration with the interest rates not going up in Europe. Mario Draghi said it's going to be early next year at the earliest. We want higher interest rates for these banks because it increases their profit margins, but you can buy them on around book value with 5% dividend yields at the moment, and I think that's a good play.
And what about Aussie banks?
Aussie banks, I just still think they're somewhere near fair value. I think what most people are worried about is if there's going to be a big recession if the housing market really rolls over. To anyone who's had a look at Wells Fargo and how it acted through the GFC, I think that's how the big four Australian banks would proceed. They actually produce a lot of money and a lot of capital each 12 months. And if they can get a 3 or 4 year period, even if they go through the worst of it, I think they'll get through.
The world is a changing place, and dare we say it, it's different this time.